Okay, this is the Order Flow Trading Course Lesson 1, Introduction to Order Flow. My name is Michael Waltos. I'm the founder of orderflows.com. First, we'll start with a disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell futures or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than their initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. The CFTC rules state hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading, and also since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Okay, so let's get started. Introduction to order flow trading. Order flow trading is a phrase you hear a lot nowadays and is being touted by a lot of software vendors. It's also being touted as, sort of the holy grail to trading. It's really not. It's not new. It's been around for decades. I mean, it's been around since the 1920s. One of the famous books on trading, Reminiscence of a Stock Operator. The main character in the book, he was basically an order flow trader. He read the tape. When markets, were traded in the pits, it was easy for locals and market makers to see the order flow and profit from it. They can see when the orders were coming in, from the brokers, from Lehman Brothers, from JP Morgan, from Goldman Sachs, or the big hedge funds, which brokers they used. They used to be able to see that very easily. I mean, that's why, these exchange memberships cost hundreds of thousands of dollars back then, because it used to be very easy to see it. And, people, that's how they made their living. But, with the advent of PCs, now the individual traders, can watch it on their screens themselves and profit from it if they know how to read the order flow. Now, you take this course, as a trader, no matter if you're a trader or anything you're doing in your life, you always want to, raise your level of, of education, whether it be in, your job, in your car. You're always striving to take it to the next level. Trading is no different. You should always be looking for ways to improve your trading. The market is constantly changing and evolving, and the trader also needs to. You got to keep up with the latest developments in the market and how to profit from it. Now, even though order flows has been around for at least 100 years, it hasn't really been followed by people outside of the trading pits for maybe the last 10 years. Most of the last 50 years, a lot of the technical developments have been in lagging indicators, moving averages, RSI, MACD, those sort of indicators. Order flow, takes the market information and basically turns it on its head and lets you look at the market in a way to determine what the winning traders are doing. The winning traders are the big traders, the institutional traders. The firms that have been around for hundreds of years, the Cargill, Goldman Sachs, Rothschilds, all these people, they've been around for centuries. So obviously what they're doing is right. The people that come and go into the market, the losing traders, those are the people's, those are the traders, the money that you're trying to take. Imagine it's like a poker game, when you're trying to take the other guy's money. With trading, you don't sit there and stare the other person in the eye. It's on the screen, it's anonymous, and so the feeling is a bit different. Now, order flow. To read order flow, you have to learn how the charts are set up. That's what this course will teach you. It'll teach you how to read, all the numbers, how to read what delta is, cumulative delta, when you have buying imbalances, point of control, all this stuff. It looks a bit intimidating at first, but it's really not. Once you understand what you're looking at, it's actually fairly easy. Now, there are two key components to being a successful trader. You have to be able to read and anticipate the market as it's trading. What that means is you have to be able to see how the market is developing and then, base your decisions off that rather than just being a reactionary trader and saying, oh, the market did this, so now I have to do this. Once you can read the market, you can play the scenarios out in your head. It's like in chess, right? You should always be thinking 3 steps ahead. If you're following indicators, you're just sitting back and then waiting for the bell to go off to buy or sell. That's not trading. That's just, following a signal. The other thing that you have to keep in mind is you have to keep your emotions in check, okay? And you have to execute the trades as they appear before you. What that means is, you have to take a step back from the market and realize what's happening and not let it get to you. It's easy to let your emotions get the best of you in trading, but you really shouldn't. You should just, be able to trade without emotion. It sounds cold, but you're doing this to make money, right? If say you're a butcher, right, and you gotta slaughter animals. Yeah, it sounds cool, but that's what you're doing for a living. And be able to execute the trades when they're happening. You don't want to sit there and analyze everything, and then by the time you decide to pull the trigger, the trade is gone. So one of the things you have to understand, okay, the market is dynamic. It's constantly changing. There's no pattern or behavior that's exactly repeated. But, there will be patterns and behaviors that are repeated, not exactly. They may be off by a little bit. Optically they're the same. But order flow will give you the clues as to what's happening in the market. So you can see that, and you can see the patterns or behaviors as it's happening and say, yes, I understand why that's happening. Now, a lot of traders fail because they think the market can't be predicted. Now, when you say the market can't be predicted, don't think of it as, okay, you're going to predict it and it's going to go, the market's trading at 1910 and you think it's going to go to 1917 and then sell off. Right now it could be trading 1910. We go up to 1915. You may be able to predict the general direction. The exact turning point will be tricky. To be able to say you can predict it to the point, to the level, the price level where it's going to turn, is really a stretch. I don't think anybody can really do that with any accuracy over a long period of time. But, what you should try to do is you should try to anticipate the market, okay? So you should be able to tell when the market's turning, where the market is forming a continuation pattern. That's what order flows will help you do. You could see here in this chart, right? The market was going up, up, up. It hits this level right up here. What do you have? You've got a lot of volume, and you got a big buying imbalance right on the top, and the market just sold right off. This is what order flow can do for you. It could tell you when you see this appearing on a chart, you should be able to, you could react instantly and know that, hey, this could be the top of a move. And, if you're able to get short somewhere, immediately afterwards, 1938, now the market sold off quite nicely. This chart only goes down to 1932, but, over the next few days, it traded all the way down to 1800. Now, once you're able to understand order flow, it'll allow you to make educated trading decisions based on what's actually occurring in the market right now, rather than trying to base your decision on, something that happened 10 bars ago. Do you really want to do that? No. You want to know what's going on right now and how to profit from it. Indicators, they try to predict the future price movements based on what happened over a period in the past. That's what moving averages are based on, an average over a certain period. Well, do you really want to be making your decision on something that happened 10 bars ago, 15 bars ago, relative to where we are now. Why don't you just be able to make decisions based on what's happening now rather than what happened in the past? It's the information that's appearing before you right now is what you want to be basing your decisions off of. What does that mean, make decisions based on what's happened in the past? Well, you should look at the past in relation to where the market is now. Yes, the best setup in a market going nowhere has a lower chance of being successful. Do you want to buy here, sell here? What direction of the past? If a big move, understand what's going on in the market. If the market's in a range, you could have the best setup, picture perfect setup, but you're in the middle of a range, so it's probably not going to be very effective. Whereas if you get that same setup and it appears, at the high of a move, that's where you want to take it. You have to know what the market is doing now and how you can trade it. So, for example, here, okay, we come down, this is, you have these ratios, this order flow, right? It's at the end of a move, right? It's not necessarily in the middle of a move. It's at the end of a move, and then the market turns around. That's what you want to take. You don't want to take signals where the market is in the middle of a trading range. You want to have it where, it makes a move, stops, and turns around, and you're looking for those areas, to buy or to sell. With order flow, you're watching the current trades that are occurring, which will help you determine whether the buyers or sellers are in control. You ask, is supply or demand greater? Order flow allows you to monitor the participation of different market participants which show up in the volume being traded on the bid or offer. So why is that important? Well, it's important because depending on what's trading in the market, is the bid being traded more or is the offer being traded more? That will tell you if there's active selling or active buying. So if the bid is trading more than the offer side, then you're having people selling into the bid. Or if the offer is trading more, you have more people buying the offer. It shows up in the delta, which we'll get into a bit later. People say the market is a zero-sum game. For every buyer, there is a seller. But order flow allows you to tell the difference between what is being traded. Is it being traded on the bid side or on the offer side? That said, is someone selling into the bid or is someone buying the offer? There's always going to be a bid and there's going to be an offer. But, for one side to trade, someone has to move their price down. Now, imagine it, you go to a car dealer, there's always cars for sale. Now, you have your price in mind, what you want to pay for the car. Car dealer has his price in mind on what he wants to sell the car for. So you guys go back and forth. Eventually, you're going to either pay what the car dealer is offering it to you at, or the car dealer is going to have to go down to your price that you want to pay, that you don't want to go over. So, say you're trying to buy this Honda car for $20,000. The car dealer wants to sell it to you for $21,000. Well, maybe you guys, maybe you'll say, okay, I'll pay $20,300. The car dealer says, well, I'll sell it to you for $20,900. To get the deal done, one of you guys, either you, the buyer, have to pay the offer price, or the dealer has to sell it to you at the bid price, at your bid price. So, that's what order flows can show you, where the trade occurred. Did the trade occur on the bid side or the offer side? Which is very important, as you'll learn, later in the course. So, order flows gives you a visual representation of price movements constructed by recording the volume traded on the bid or the offer. It provides insight into market psychology as well as market conditions, and the value lies in confirming market tops and bottoms, as well as price areas where there have been shifts in supply and demand. Again, why is that important? Well, the market is made up of participants, and the way they think shapes what the market is going to do, whether it's going to go up or it's going to go down. So if you have participants who are actively buying the market, that tells you there's the market psychology at the moment. It tells you, people are thinking the market's going higher and they're buying, aggressively lifting the offers. So, the market is always at a tug of war between buyers and sellers. Each side is trying to assert themselves and take control. And you should always be asking the question, who is in control? Is it the buyers or is it the sellers? Once you know who's in control, you can see when control shifts from one side to the other. Once you understand how to tell who's in control, you can anticipate the price movements as they occur. So you can see as one side becomes stronger, how the market is going to move. You can anticipate that you can see that, okay, well, buyers are taking control. So strictly by knowing that, you can anticipate that there's going to be a move higher. You can see, if you see sellers are starting to overrun the buyers, sometimes that's very easy to see with order flow. You can't necessarily see that with normal price bars. But when you see that, you can anticipate, okay, now, we're going to get ready for a move lower. Perfect example is this chart here, it came down a little bit, bounced up, then you just see the sellers really take over. They just overran the buyers here. Market tried to come back up, you got some more aggressive selling, and the market just sold off. This is, what order flow offers you. It offers you a chance to see this very clearly. If you're just looking at a bar chart, you just see, the market popped up, and, sort of went sideways and starts to come back off. But you can see very early, immediately after the bounce up, that the aggressive sellers came back in. Surely, that's, you cannot see that on a normal bar chart. Order flow footprint charts are superior to bar charts, candlestick charts, because they provide actionable visual insights into the psychology of what's currently happening in the market. The trading clues that you get from an order flow footprint chart are immediate and hidden from users on bar and candlestick charts. Perfect example. Here's a candlestick chart. Okay, and you can see the market went up. Yeah, you got a red candle. Okay, what does that mean? You went sideways after it. Another red candle looks almost exactly the same. You got two green bars going up, two green bars going up. You got the red candle here. You got the wick. Are we going to go sideways? Are we going to keep going up and go down? It could really go anyway, by looking at that. But, if you're looking at the order flows chart, you could see, the red candle, market goes sideways, comes back up. Again, you got this high here. You can see here, you can see massive volume up here at the top. This is your sign that the market isn't going to go any higher. You know right away you want to be short. That the market should not be going sideways. It has more propensity to move short. This is this is how it looked. Coming into that chart. You don't know. Is the market going to go higher? Or is it going to stop? Go back to the chart. It went back up. Here, turned around. You could see it in the order flow. You could see the orders, what's being traded, and then it sold off. Okay, what's the market going to do when it gets to this level? Is it going to go up, going to go down? You don't know. But if you're looking at the order flow, you can see here, the market's in an uptrend. You see the aggressive buying going on here, 936, 200, 2000. You can see the people being aggressive here that move up. So, what is order flow? Order flow is a tool. It's not a system. It's used in context of what's occurring in the market. Order flow makes analysis quicker and more efficient, provides an in-depth view of what traders are doing in the market. It's particularly useful in signaling trend changes as they happen, which is much earlier than those generated by convention. So, with order flow, you can see changes in trend as they're happening, not after they're happening. And so see trend changes as they happen, which is much earlier than those like conventional indicators. So with order flows, you'll see them as the trend is changing, not after it's changed. Okay, order flows shows what's happened in the market. It's a tool, right? That's partially understood by other traders. It looks confusing to people that don't understand it. This is the only tool that gives you immediate feedback on what is happening now in the market. As with any form of trading, your goal is to buy at a lower price than you sell. Or sell. Order flow is vital in spotting reversals. Most reversals are short-term, which is precisely the type of short-term that short-term traders look for on a regular basis. It can be used on other trends, but my emphasis will be on trading. Order flows use to confirm trends once they've started. This will help keep you in moves once you are in. If you're in a trade, lots of times you're thinking, hey, do I get out now? Do I stay? With order flow, you can decide, very easily if you should stay in or get out of a trade. For example, here, markets come up. Okay, you're looking to get short somewhere in here. You get short, based on what you're seeing in the order flow right up in here. Okay, and then you have all these selling imbalances right in here. You get starting to get some more indication. So you don't have to necessarily get out right away. You're getting indications. Besides the bar closed lower than it opened, so it's going down. You could see the selling coming in. You could see the price rejections in the bars. So you know that the market is going lower. You can be more confident in your trades. So order flow is not your typical technical analysis tool. It places greater emphasis on volume. Volume should not be ignored. Without knowing the volume traded and how it traded, you have no idea of the conviction involved in a move. In the old days, when people talked about volume, it had double meaning. In the pit, there was volume, the number of contracts traded, but there's also volume with how loud it was in the pit, whether it was quiet or whether it was noisy. If it was noisy, then there's a lot of volume being traded. So when you connect price and volume, it tells you what other traders are doing. It allows you to take advantage of that knowledge. When the big traders are in the market, you want to know that. Where they're trading, you want to know that. If you don't look at volume, you don't know. All you're seeing is just a line on a chart. It doesn't tell you much. You're really leaving out a big section of the market. Now, fundamentals do not directly determine price. They're only as important as the emphasis placed on them by the traders who analyze them. What that means is you can have fundamentals do not directly determine price. What that means is it's hard for you to trade fundamentals for a retail trader to trade fundamentals because they don't have access to the same fundamentals that the producers have. You don't know the supply chain. You don't know that it's raining in Indonesia or Malaysia, that they can't harvest the palm oil. You don't know what the shipping rates are currently and how they're affecting the cost of oil. But does that matter? No. It's what the other traders are analyzing them at that you want to know. And yeah, you're going to see it reflected in the price that's trading. But the market, it doesn't necessarily reflect one individual's consensus. It's consensus. So it's going to be it's going to be a wide range of people and what they think. The market determines the fair price, but the volume trader represents the strength of interest in that determination. And so that said, I mean, the market determines the price, right? But how much is traded represents, whether people think it's legitimate or not. I mean, if it trades on a very small size, then it's most often it's not legitimate. For example, going back to this chart that happened before, you can see, up here, this is in the minis, right up here, there's very heavy volume. On the way up, everyone was eager to buy, as we're making new highs. Then it just stopped up here. There was a big seller, and basically they'll whack it back down. It traded a decent volume up here. There's 1,600 lots at the high of the day, the high of the week, the high of the bar. It's telling you, the market couldn't get past it, and the thinking has shifted in the market. Whereas buyers were really taking control. But you got up here, you got a big seller that's taking control. It may not just be one person; it might be a few people, and then the market sold off. That's what order flows helps you see. You can see where things are changing in the market as they're happening. So to make money in trading, it's necessary to have a disciplined approach to trading. It's important to keep things simple. Order flow seems complex at first. However, once you learn how to read and understand an order flow chart, you'll be able to better know what is happening in the market and become disciplined as a trader, which is, what you want to do. You don't want to make things so complicated that you get paralyzed with your analysis that you can't decide, should I be getting long? Should I not be getting long? Should I be getting short? I don't know what to do. You want to keep things simple. You want to have a way of trading that it becomes second nature. Luck is not a strategy in trading. So, learning order flow is like learning any new life skill. The more you practice, the more proficient you become. You have to learn the basics, get them down cold, because as you start to move to more advanced techniques in your training and trading, you start to struggle. You can just go back to the basics. Most traders don't even have the basic education in order flow trading. Imagine it like you're driving, right? When you learned how to drive, there's a lot you had to take in, but now, after you've been driving for a while, you understand what you're doing. You don't have to go through, a standard list of things when you're driving down the highway. You know how to act when someone cuts in front of you, or when the car in front of you slams on the brakes. You know exactly what to do. With order flow trading, you will learn the same things on what to do with the market and how to react. I'll be honest, when I first saw a footprint chart, I was already aware of the volume importance in trading. It's one of those things, I didn't even know back in the early days that, these types of charts were available. I used to sit on a desk where I had massive orders going through. I could sense what's going on. But, once I saw the order flow chart, the footprint chart, it really, opened my eyes to a whole new world. So it's necessary to see and determine whether volume was heavy or light as the market moves through levels of support or resistance. Again, if you're just looking at it as a bar chart, and you break a trend line, you don't know if the volume was heavy or light. Like I said, you just see a straight line on that they went through. I'm sure some, pure technicians will say, well, you broke it, even if you broke it on one lot. Well, nowadays, trading is very different. There's a lot of algos, and just because it's an algo doesn't mean it's a smart algo. It could just be buying one at the market. You don't know. In the past, volume was often relegated to a secondary significance, or even completely ignored by most traders. People used to look at volume at the end of the day. They didn't necessarily look at it intraday. They would just, plot it along the bottom and say, well, okay, today what was the volume? Was it heavier or lighter? They didn't actually analyze it intraday and, really try to understand what was going on in the market and how the market was being affected by the volume. So you can't understand the dynamics of a price movement without understanding the volume. So it's not new information. You're taking the same information that's been available, but you put it into a format that makes it much easier to interpret. You can determine how prices are changing rather than just seeing that they are changing. Example, here's a chart you could see. Okay, we're working our way up, We hit the high, start to come down. What's in order flow will help you tell what's going on in the market, why we hit this, why we're starting to sell off after hitting the high. I mean, yeah, you can say, well, there's sellers coming in, but are you sure? Do you really see the selling coming in there? When we come back up into this bar, is there selling? Can you determine that, we're going to sell? Why didn't we come back up and take out this high? Well, this is all the things that order flow will help you tell. So, so this is the end of the first lesson, lesson 1. In the next lesson, I'll discuss the different choices of order flow software that are available on the market for traders to choose from. I mean, there's a lot out there, various prices. And it's just, literally from almost free to, tens of thousands of dollars. It's easy to be misled. So, thank you, and, end the first lesson for now.